If you're a property investor or planning to be one, your lending playbook may have just gotten thrown out the window. In a shock move, a number of major Australian banks have changed their policies when it comes to trust lending. Now, this comes just weeks after another major bank paused all lending to trusts and companies entirely. So why does this matter? Because for years, sophisticated investors have used these structures to supercharge their borrowing capacity, giving them the ability to continue to borrow and buy properties. But as of this week, a number of major heavyweights have said enough. Is this just a policy tweak? No. APRA is quietly pulling the handbrake. In this video, we'll break down the new rules, new policy settings, what the trust recycling structures were used that raised alarms for some of the banks, and a way forward. So what just happened? First, the facts. As of late November, one major bank introduced a strict new policy. To borrow in a trust, you must have an existing relationship with the bank for at least 6 months. No new customers allowed. This follows another major bank who in October pulled the pin entirely. And in a statement, they particularly cited social media posts. So let's break down what the issue is, what are trusts, how are they used when it comes to lending. Now, to understand this crackdown, you have to understand trust recycling. Normally, banks stress test debt against properties at a 3% buffer. So for example, let's say your interest rate is 5%. They'll assess you at 8% and to see if you can make the repayments. Stress testing. Now, this is relevant to particular institutions that are deposit taking, i.e. the banks. Now, over the last few years in a relatively higher interest rate environment, you can imagine that 3% buffer has limited people's borrowing capacity. As such, people have looked for other strategies to continue to build their property portfolio. And one of those strategies was trust lending, whereby people were able to structure their debt within trusts and build them in a way to state that they were self-sufficient, i.e. the incomings were able to cover the outgoings, rents cover the mortgage, etc. That could be through an accountant and through other means. Oftentimes, there were lenders that were willing to not use these structures when assessing debt. So as long as they were given assurances that they were self-sufficient, they wouldn't be considered for the borrower's new application, thus giving additional borrowing capacity. So what was the issue? What was the risk? Well, certainly if rates rise, these debts weren't actually looked at and assessed where perhaps they should have been. Additionally, banks have realized that there's a number of debts that they hadn't necessarily assessed. Now, where there's instability in the market or some sort of stress, these things could be exacerbated. So now let's look at the data. And now this is where it gets interesting. This isn't solely about Spruikers on TikTok, it's about systemic risk. According to the latest ABS leading indicators, new loans surged by over 13% in the September quarter alone. That's the highest level of investor activity since about 2022. Right now, investors make up roughly 40% of all new loans funded. It's a massive chunk of the market. And in some states, investor loans are record highs in terms of the percentage of total lending. Now, we've seen this movie before when it comes to APRA. If we go back to 2014, APRA instituted a 10% speed limit on investor loan growth, meaning lenders were limited to grow their investor book by 10%. In 2017, they crushed borrowing capacity by capping interest-only loans, forcing lenders to charge a premium on interest-only loan products. Previously, interest-only loans were available at the same rate by many lenders. And now in 2025, we're seeing the focus come into trust structures when it comes to lending. APRA's job in part is to stop the housing market from overheating. When they see investor activity, lending spiking like this, they lean in to force the banks to pump the brakes. A handful of majors have made the first move. Keep an eye and watch this space as others may choose to follow. Now, the Spruiker issue. The banks didn't mince their words. They explicitly called out social media strategies. We've all seen the social media posts promising your ability to buy a boatload of property, unlimited borrowing capacity, and there are a number of issues with these types of posts. Oftentimes, these types of strategies do not take into account an individual's circumstances, and the reality is, for most people, they're not suitable. So where to from here? We've talked about a number of issues, a number of problems. What does it mean for you going forward? Ultimately, your strategy needs to be agile enough to succeed and pivot. We've seen the environment always have changes. We've seen the regulator and banks tweak their policies, change their policies. Your strategy needs to be able to withstand these types of changes over time and adapt. Number one, don't panic. Trust lending still exists. It's just harder to get from major lenders as it was previously, and in particular lenders that were quite favorable when it comes to the ability to work with. The options are still available through other particular lenders, but again, it's a time to reassess and see if this kind of strategy actually is beneficial to your set of circumstances. Two, there are competitors, tier 2 lenders that are out in the market. They may not be as competitive for various reasons. However, they may provide options for those where this type of strategy may still be appropriate. Important that you break down the numbers and see if it actually makes sense. 3, great time to audit and review your strategy. As the lending environment changes, interest rate environment is currently shifting, your ability to borrow has changed. It's a great time to review your short, medium, and long-term strategy and overlay that with the lending environment. The days of easy, unlimited credit are definitely over. It's important that you reach out to your strategic lending advisor to make sure that your strategy is fit for purpose.